With June inflation dropping to 3.5%, will mortgage rates finally come down?
This could save home buyers a whopping $10,000 on a $500,000 mortgage. This video is designed to help first-time home buyers understand the current market and make informed decisions. You will learn how the inflation rate affects mortgage rates, the impact of inflation on the housing market, and strategies for navigating high inflation. Additionally, you will understand the role of interest rates in the economy and tips for making informed decisions in 2026.
What is inflation rate?
Inflation rate, also known as the rate of inflation, is the percentage increase in prices of goods and services over a certain period. It's measured by the Consumer Price Index, CPI, which tracks the average change in prices of a basket of goods and services. A high inflation rate means that prices are rising rapidly, while a low inflation rate means that prices are stable or rising slowly.
For example, if the inflation rate is 3.5%, it means that the prices of goods and services have increased by 3.5% over the past year. How does inflation affect mortgage rates?
Inflation rate has a direct impact on mortgage rates. When inflation is high, lenders increase mortgage rates to keep pace with the rising prices. This means that borrowers will have to pay more interest on their mortgages. For instance, if the inflation rate increases from 2% to 4%, mortgage rates may rise from 4% to 6%. On the other hand, when inflation is low, mortgage rates tend to decrease, making it cheaper for borrowers to buy a home. A $500,000 mortgage with a 4% interest rate will cost $2,387 per month, while a 6% interest rate will cost $2,998 per month, a difference of $611 per month. Impact on housing market. The inflation rate also affects the housing market. When inflation is high, the demand for housing decreases, as buyers are less willing to pay high prices. This can lead to a decrease in housing prices, making it more affordable for buyers. However, when inflation is low, the demand for housing increases, driving up prices. For example, in an area with a low inflation rate of 2%, housing prices may increase by 5% per year, while in an area with a high inflation rate of 6%, housing prices may decrease by 2% per year.
Strategies for first-time home buyers.
As a first-time home buyer, it's essential to understand the current inflation rate and its impact on the housing market. One strategy is to consider buying a home when inflation is low, as mortgage rates are likely to be lower. Another strategy is to look for homes in areas with low inflation rates, as housing prices may be more stable. For instance, if you're buying a $300,000 home with a 20% down payment, you'll need to pay $60,000 upfront and $240,000 in mortgage payments over 30 years. If the inflation rate is 3.5%, your monthly mortgage payment will be $1,054, while a 6% inflation rate will increase your monthly payment to $1,432.
Role of interest rates in the economy.
Interest rates play a crucial role in the economy, as they affect the borrowing and spending habits of consumers and businesses. When interest rates are low, borrowing becomes cheaper, and consumers are more likely to buy homes, cars, and other big-ticket items. However, when interest rates are high, borrowing becomes more expensive, and consumers may reduce their spending.
For example, in 2026, the Federal Reserve may increase interest rates to combat high inflation, which could slow down the economy.
A 1% increase in interest rates can decrease consumer spending by 2%, which can have a significant impact on the overall economy.
Tips for making informed decisions in 2026.
To make informed decisions in 2026, first-time home buyers should keep an eye on the inflation rate and its impact on mortgage rates.
They should also consider the overall state of the economy and the housing market.
Additionally, they should research and compare different mortgage options, such as fixed-rate and adjustable-rate mortgages, to find the best deal. For instance, a fixed-rate mortgage with a 4% interest rate may be a better option than an adjustable-rate mortgage with a 3% interest rate, as it provides more stability and predictability in monthly payments. If you're a first-time home buyer looking to navigate the current market, click the link in our description to download our free guide to understanding inflation rate and its impact on mortgage rates. Don't forget to subscribe to our channel for more first home buyer tips and market updates.